When we talk about money being lent, in the case of a small loan of say $50,000 to a business, that would be a private loan between a bank as a provider of capital and say a restaurant as a user of capital, and there would be certain terms attached to that loan. Same thing for a mortgage. Somebody that borrowed money in a mortgage, on a mortgage, the bank would typically provide the loan as a provider of capital, and the user of capital, the homeowner, would pay interest on that loan. Now, when companies and governments borrow huge sums of money, what's done is that lending is split into smaller slices. And that's done for a number of reasons, including if they split into smaller slices, they can borrow from more entities. Just a greater number of entities have the opportunity to lend money. So instead of going to one party who's going to lend some money, they can go to thousands of parties who are going to lend smaller or more manageable amounts, but ultimately creating a huge sum of money. And it also allows them to have liquidity. It also allows them to borrow again and again, because they can issue more bonds effectively and borrow more money. So when lending gets very big, again, the lending is split into smaller slices known as bonds. So instead of borrowing $1 million from a bank or $50,000 from a bank, a big company will borrow $100 million by issuing, for example, 100,000 bonds of each of $1,000. And everybody that buys that bond has effectively lent money to that company, and their return will depend on the interest rate and the terms that have been defined for that bond. So a bond is a securitized lending instrument, i.e. it's parceled as a security, a tradable instrument, but it reflects an underlying loan or debt, where the terms are very much like debt, with interest rates. Returns depend on interest rates, and there are numerous terms that are used to apply to bonds. But the most important thing for the purposes of this discussion is a bond is a piece of the debt of a company or a piece of the debt of a government, typically, where there is a return defined by interest rates, and it is in contrast to stocks, which are ownership interests and which are slices of the equity of a company.